Financial markets went on quite a ride over the past few years. Did you grin and bear it because it'll work out over the long haul? Well, as much as that may indeed turn out to be the right approach, portfolio manager and author John De Goey has some cautionary words for those inclined to see the glass as half full. He explains in his new book, it's called Bullshift, How Optimism Bias Threatens Your Finances, and John De Goey joins us now. One does have to be careful how one says the title of your book.
You think?
I think, yes, indeed. First of all, welcome.
Thank you so much.
Good to see you again. Let's do an excerpt from the book and then we'll chat some, okay? Sheldon, if you would, let's bring this up. It goes without saying that people don't spend time worrying about things that they are oblivious to. This is a book about a problem that hides in plain sight, yet persists because so few people recognize it. For about a generation now, there has been a growing body of evidence that traditional economic assumptions and models are flawed. In these models, people are assumed to be sensible and self-aware. In fact, though, all of us are essentially misguided or biased. Many of our choices seem entirely reasonable, yet they often fail when put to the test in the real world. Despite this, many traditional economists act as though their demonstrably incorrect assumptions are reasonable. People who provide financial advice are similarly blinkered. Houston, we have a problem. What is the problem you see hiding in plain sight?
People honestly think they're doing the right thing when they take a positive approach to investing. That's true for investors. That's true for the people who give investment advice to investors. And that works out 19 times out of 20. It's usually a very good way to look at things. But when you are optimistic to the point of denying realism, where you don't even think about what could possibly go wrong, there's a real risk that you're taking on more risk than you otherwise would or should, and that you could leave you exposed to real problems if markets tumble.
Isn't being optimistic a better way to live?
It sure is. In fact, a lot of the research shows that optimists, Danny Kahneman, who won a Nobel Prize in 2002, said that if you could give any one thing to your kids, it would be to wish for optimism or joy, because it correlates positively. Optimistic people live longer, they have happier marriages, they're more fulfilled in work. Any way you look at it, optimism is a good thing.
And you're telling us not to be that.
And I'm saying it is a good thing. Be optimistic. Just be careful. Just don't overdo it, because too much of a good thing can be no good too.
There are a lot of biases out there, and yet you've chosen to focus on this one in particular. Why this one?
So optimism bias is when you think things are not going to happen to you. So you're overly optimistic because you think, oh, other people will get divorced, but not me. Other people will be in a car crash and not me. And because it is the sort of thing that is generally thought of as being the good bias, it's the one that people sort of skate over. They don't think about it. They just sort of say, it's going to be fine, I'm going to be fine. And that's where the risk is, because you don't contemplate what could go wrong. That's how you sort of think, oh, well, this isn't going to go wrong, so I'll be fine. And that's when things go wrong.
You want to define Bullshift for us? Gosh, I'm being so careful the way I say the title of your book.
Yeah, you've done a great job so far.
Thank you.
So I've talked about optimism bias already, so the book is about optimism bias, but Bullshift is a portmanteau that I've coined, which talks about how the financial services industry shifts your attention to being bullish. So it's a sort of like a jiu-jitsu where you sort of look over here, and they always focus on the glass being half full, as if that will get you through whatever it is that you need to get through. And usually it works, but not always.
Don't you want to, though, I mean, you're in the business of sort of encouraging people to give you their money, and you invest it, and things you hope turn out well. By writing a book like this, are you not, in some respects, arguing against your very own profession?
So this is my point, is I don't want to argue against anything. I want, and like any profession, law, medicine, accounting, you want to be as professional, as evidence-based, as client-centric as you possibly can. And my point is, 19 times out of 20, optimism works out. The problem is, people who do what I do for a living are loath to talk about, what about that one time out of 20 when things might not? To hear financial advisors tell the story, it's always a great time to invest. There's never a time to be worried. And surely to goodness, it must happen sometime.
Mind you, if my financial advisor came to me and said, I can make you money 19 times out of 20, I would take that. Don't you think most people would?
Sure. But if you could find a way, and I'm not suggesting you can make money 19 times out of 20, just to be clear, but over long time horizons, I saw something on Twitter the other day that if you take 10-year chunks, 19 out of every 20 10-year chunks, the market is up over that time frame. So that's why I use that number. But there will be instances where you can go a full decade and not make any money. And if it looks as though one of those instances might be on the horizon and you're risk averse, could you at least consider doing something a little bit differently? I think you might want to.
You make a reference in this book to, and I hope I'm going to say this properly as well, because I've never heard of it before reading the book, the Semmelweis reflex? Reflex.
Yeah.
Is that right? Semmelweis?
Semmelweis, yes.
Reflex. What is that?
So there's this guy named Ignaz Semmelweis who in the mid-1800s was a physician. He's from Hungary. He was practicing in Vienna. And what he found was that if you wash your hands, if doctors wash their hands, they will do a much better job of mitigating the transmission of diseases. And it helped to reduce puerperal fever because the women at hospitals in Vienna were dying and having various infectious diseases at a 10 times greater rate than the women who were giving birth with midwives. So there was obviously something wrong. So he figured out this is probably why it is. He did the research, did all the empirical testing, brought it to his fellow physicians, and they pilloried him. They hated him for having the audacity to actually bring forward evidence that disproved their pre-existing worldview. And that's a real problem because professionals are supposed to be making decisions based on evidence. And it's true that a lot of people think they want to do what's right, and they say they want to do what's right, but when you actually get right down to it, when your identity is being challenged, when the doctors of the day in Semmelweis's time, they would say, I'm a gentleman. I can't be part of the problem. I've taken a Hippocratic oath. I'm here to be part of the solution. So they gave him a hard time for having the audacity to suggest they might be part of the problem. And that's sort of kind of what I'm dealing with as well.
I was just going to follow up. So how is that relevant to what you see in financial services nowadays?
So the financial services industry is like any other industry. It wants to do the right thing. The people who offer advice are almost universally positively inclined. They have good intentions. They do a good job. This is not to cast aspersions on intent. This is to say you still need to stop and think about, despite your good intentions, are you doing things properly? And if you're not doing things properly, or if you could do things differently, shouldn't you reflect upon that and maybe try doing things a bit differently?
We do remember the time. I mean, I think you and I are probably both old enough to remember. There was a commercial that used to run on television. 4 out of 5 doctors recommend you smoke this brand of cigarette
for sure.
if you're going to smoke cigarettes.
Yeah,
so,
and we have banks saying you're richer than you think. There's a lot of optimism that's sort of embedded in the system that we don't even think of it. We just take it for granted and we assume that, oh yeah, that's good, because we want to be optimistic.
Do you think it's nefarious? I mean, we understand that it sort of plays upon our desire to be hopeful about the way things work, but do you think they have nefarious intent as they do it?
So then it becomes a question of the extent to which they internalize the evidence. So if I say to you, so I'll give you an example here. Have you ever heard someone say, Steve, we're in a lottery number picker's market?
No.
No, because it's ridiculous.
It is,
no one
on
would
the
say
face of
such
it.
a thing, right? But in my business, for 100 years, people have been saying, we're in a stock picker's market. And it's the same sort of bullshift. It's the sort of thing where you say it because you want people to think it's true, but if you stop and reflect upon it and you think about it logically, well, whenever a stock is traded, there's a buyer and there's a seller, and if one of them benefits, the other one suffers by an equal amount. Net, there's no gain. You're not doing any better. It's not like it's better to pick stocks on Thursday than it is on Friday. It's not like, we're in a new moon, so now we can pick stocks. There's no such thing as a stock picker's market. But the industry says it because it's good for business, and people buy it because they want to believe that it's possible.
Are people in your business giving you a hard time when you put this forward?
Sometimes. People in my business have been giving me a hard time for a while because I've been trying to move the ball forward to make things more professional and more transparent and more evidence-based. But when the evidence makes people challenge their own self-identity, they don't always like to hear it.
Okay, here's another term from the book. The Stockdale paradox. What's that?
Jim Collins, in his book Good to Great, talked about this. There was this Admiral James Stockdale, who was the senior ranking officer in the Hanoi Hilton during the Vietnam War. And in Vietnam were, as you might imagine, all the GIs, they're being tortured, they're being, all manner of things are being starved. And by the time the war ended, only a few hundred GIs got out. Thousands of others died in captivity. So the press naturally went running to Stockdale and said, so you made it out and the other guys didn't. Like what made you and the other guys that made it out, what's so special about you guys? And Stockdale says, well, that's easy. The guys who didn't make it out, they were the optimists. And the press went, what are you talking about? Well, it turns out that the optimists were the ones who would say, well, we'll get out by Christmas, or we'll get out by the 4th of July, or and they kept on setting arbitrary dates, and then the dates would come, and the dates would go, they wouldn't be out, and they would lose hope. So the Stockdale paradox is where you have to be able to have the stoicism to stick with whatever it is you want to accomplish, no matter what, come hell or high water, and then at the same time deal with the brutal reality of what it is you're dealing with. And you can't sugarcoat the reality, but you can't let go of the objective either.
I seem to, you tell me if I'm remembering this right, was he not Ross Perot's running mate?
He was Ross Perot's running mate. He was indeed.
Yeah, when Ross ran for president. You draw the distinction in your book between classical economics and behavioral economics, and we've talked about both those things on this program, but maybe just help us out again. What's the key distinction between the two?
Almost everyone who gives financial advice and who works in the financial services industry uses classical economics, and that is based on the idea of supply and demand, the things that you usually think about. People are rational, utility-seeking, utility-maximizing optimizers, people who make good, smart decisions based on what's best for them because they're very good at synthesizing information and making a decision based on that synthesis. Behavioral economics, in contrast, has been the upstart, and if traditional economics made sense, then there would be no anomalies, there would be no exceptions. But in fact, what the behavioralists are showing is that there are dozens of exceptions, and they are predictable. They happen people are predictably irrational. They make the same mistakes all the time, and those mistakes are usually rooted in self-interest and thinking too quickly and not really stopping and reflecting and just doing what seems right without actually stopping and saying, is that really the right thing to do? So when you think about how a lot of the evidence of economics is that what we think is going to be true, what we think is going to work doesn't necessarily work, maybe we should stop and reflect upon, well, what actually does work? And that means thinking more about social psychology and the way we all want to fit in and the way we sort of want to keep up with the Joneses and the way we do things that because other people are doing them, there's FOMO, there's the fear of missing out, there's the TINA, there is no alternative. There's a whole bunch of different things that we do that are just part and parcel with the way we invest and the way we go about our lives that we don't give it a second thought, and yet it's not rational.
You quote Dan Ariely in the book.
I do.
Who's the leading guy, I guess, on this behavioral economics. You ever met him?
Yes, I have.
He's terrific, isn't he?
He's fantastic.
We've had him on this program a number of times. He's just great. Okay, you've told us the kind of role that you think financial advisors ought not to be playing. How should they be playing it?
The first thing they need to do is they need to learn more about behavioral economics, because financial advisors, if you ask them, will almost all say, what I do for a living is I'm a behavioral coach. Okay, that sounds good. I could use a behavioral coach. We could all do better if we had a coach. But a behavioral coach says, I'm going to help you to focus on the things that are going to be more purposeful in your life. So I'll help you to save more. I'll help you to take a long-term perspective. I'll make sure you know whether to put the money into your RSP or your TFSA, what have you. But the coaching that needs to be done and the things that need to be learned is advisors need to think about, okay, if I'm going to call myself a behavioral coach, what do I know about behavioral economics? Is this client of mine anchoring on a previous number because they had a portfolio that was worth more at some date? Are they guilty of recency bias because this worked out last time and therefore I'm just going to do the same thing all over again? There are a number of biases that we're all prone to that if we're more familiar with what they are, we could do a better job of coaching our clients out of those problems.
Do you attempt to get financial advisors to buy into this different way of looking at things?
That's a big part of what the book is about, yes.
How well is it working?
So far, not so well. But that's the problem that I talked about with Semmelweis, right? People don't, if you think you've got something down, whatever it is that you do for a living, the last thing you need is someone coming along and saying you're doing it wrong, or I'm not necessarily saying you're doing it wrong, but you can do it better, you can do it differently. Here's another way of looking at things. People are going to say, yeah, but I got it down. Why do I need to do it differently? I'm doing it fine.
Because you make the case
as
here.
it is.
You make a good case in the book that people are doing it wrong.
Yeah.
And they're not open to reconsidering how they've been doing it?
For the most part, they are not.
Is that depressing?
Yes, but I keep on trying because it's the sort of thing where the objective is good enough and important enough that you have to keep on trying, which is, I guess what I'm saying, I'm also a bit like Stockdale. I'm optimistic that we're going to get through eventually, and I've been trying this now for 20 years, and I'm not always the most popular guy around the water cooler, but I don't mind. If you believe the cause is worthwhile, you keep on pursuing it.
What are robo-advisors?
Robo-advisors are the things that have been around now for about 8 or 10 years. They've been around for a bit longer, but they've been prominent for the past 8 or 10 years. And they are companies that will use artificial intelligence, and they will use exchange-traded funds usually as the investment vehicles. You do a questionnaire, and they will then build portfolios that's based on your scored risk profile, and they will help you to do things without the use of a human advisor to get you from A to B.
In which case, if they're not human, with human foibles, frailties, egos, can they give you better advice than a human can?
That's an open question when it comes to market performance, because right now we've had, I think the real test for whether a robo-advisor can do a better job than a human is when markets turn south. And since robo-advisors came on board, the only time we've had a real downturn was for 5 weeks in 2020 when COVID hit, which is too short to have a meaningful sample size. So the jury is out. We don't really know if robo-advisors will do as good a job or less good of a job or a better job of modifying behavior on behalf of their clients, because we don't have enough data, because we haven't actually been able to test the hypothesis.
Got it. Okay, in which case, if you have financial investors who are interested in this book and who are interested in the way you do things, but they have a financial advisor at the moment who they're not sure is aligned with you on this, what do you recommend that they do?
The first thing you should do is you should do a careful self-assessment. So regulators here in Ontario, we've just merged the two main self-regulatory organizations. They've decided that the way that you should look at suitability is through a lens of two main tests. Do you have a suitable risk tolerance, and do you have a suitable risk capacity? So when you think about, am I maybe being too optimistic, and is my advisor being too optimistic in what he or she is recommending to me, you need to go back and say, okay, so what is my risk tolerance or my risk capacity? And think about it in terms of, well, what could go wrong? Because a lot of people will say, this is my attitude, but they'll have their attitude based on the recent past, and the recent past has been not that bad, thank you very much. And as a result, they'll say, oh yeah, that's fine, I can handle things, because what you've had to handle in the recent past hasn't been that bad. But if you do a careful assessment and say, okay, how would I react if the market dropped 30%? What if it was 35 or 40%? Would I be able to handle it? And then you do the other question of, okay, well, what about my capacity? Even if I could handle it psychologically, what if it didn't come back for 5 years? What if it didn't come back for 7 years? And you're retired or nearly retired, and you're starting to draw money from that. Even if you can handle it psychologically, you might not be able to have the capacity to withstand the drawdown. So those are the sorts of things that you need to think about and reflect upon to make sure your portfolio reflects your tolerance and your capacity now, before anything really bad happens.
As a general rule of thumb, do you find that financial advisors like their clients to take perhaps more risk than they ought to?
I would go further than that. I would say most financial advisors actively encourage their clients to take a little more risk than they otherwise might, because most people are probably a bit too conservative most of the time. And so all advisors are doing is they're behaviorally coaching them to say, you know, you don't need a portfolio of 60-40. I think, Mr. Jones, you could actually handle a portfolio that's 70% stocks and 30% bonds. And if Mr. Jones says fine, and the advisor can make the case, there's not really a great deal of difference. We're talking about a fraction of 1% in terms of the long-term rate of return. But if you can handle the risk that goes with that extra 10% equity exposure, that might shave 2 or 3 years off your retirement date.
That's significant.
Yeah.
Let's finish up on this. I imagine there are some people watching this or listening to this right now who do not have a financial advisor, but they still want to invest their money as wisely as possible. Speak to them. How do they avoid the bullshift?
The way evidence shows that people are very poor at self-assessment. So they can recognize bias in other people better than they can recognize bias in themselves. Given that that's the case, the way that you test it is to sit down with your spouse or your buddy at work or whoever, and you ask one another questions about, am I really anchored on what happened last week? Am I following the news too much and making decisions based on knee-jerk things that are not really systemic and long-term, or not? And then you start thinking about, well, if I am, what can I do about it? And again, it requires careful, meaningful, purposeful self-assessment. And we're not good at assessing ourselves, so we have to get third parties in. I assess you, you assess me, and I'll do a better job of telling you where your blind spots are than you will, and you'll do a better job of telling me, because we don't recognize them in ourselves. So you have to do the careful self-analysis, but do them with a friend.
Interesting. John, you're a podcaster too.
Yes, I am.
What's your podcast called?
Wait for it. You're never going to guess. It's called Bullshift.
You're kidding.
The podcast. So Bullshift, the podcast, has been out on all various social media since the beginning of the year.
You enjoy it?
I do, yeah. It's great. And that's where you can talk about these things. So anybody watching the show tonight, they'll say, well, That's fascinating. I'd love to do more, and maybe you'll read the book. I hope you read the book. But if a lot of people these days, they don't have the time to read a book, but they've got half an hour that they can kill while they're going for a walk on a Sunday afternoon or whatever, they can just pull up Stitcher or iTunes or whatever. If they're sitting at home, they can pull up YouTube and watch Bullshift, the podcast. I talk to a lot of people that are smart, that offer their perspective on behavioral finance, and especially about optimism bias. Good stuff. I'm going to try the title of the book one more time. Been pretty good so far. Bullshift, How Optimism Bias Threatens Your Finances. John J. De Goey has been our guest. Thanks, John. Good to see you again. Thanks, Steve.
The Agenda with Steve Paikin is made possible through generous philanthropic contributions from viewers like you. Thank you for supporting TVO's journalism.